You know those awful movie sequels? The ones nobody, and I mean nobody, asked for. The ones that just keep going long after the credits should have rolled? Well, welcome to the economic equivalent. Inflation, the unwanted sequel. It's the disaster blockbuster of 2026, and we're going to break down how we all ended up with a ticket to this show. So let's set the scene. It's late 2025. And you know what? The mood is pretty good. Economists, central bankers, pretty much everyone on Wall Street, they're all taking a victory lap. The thinking was, we did it. Inflation, the big bad of the early 2020s, it's been defeated. It's heading right back down to that cozy 2% target. The worst was over. Or so we thought. So what went wrong? Ha! The real question is, what didn't go wrong? It turns out that happy ending wasn't really an ending at all. It was just one of those post-credit scenes, teasing a sequel that was about to get a whole lot darker. And just like in any good horror flick, the monster wasn't really gone. Nope. It was just lying dormant, waiting for the right moment, the right crisis to come roaring back. And in our story, that crisis has a name: the Strait of Hormuz. Now, this isn't just some headline you skin past. The Strait of Hormuz is, and I'm not exaggerating here, a critical artery for the entire global economy. Think about it. About a fifth of the entire world's oil supply has to squeeze through this one narrow waterway. So when conflict flares up there and shipments get disrupted, it's like a sudden, massive heart attack for global energy markets. And the results were immediate and just brutal. Since late 2025, oil prices have absolutely rocketed up by 84%. I'm going to say that again, 84%. Just, wow. But wait, there's more. If you thought that was bad, the shock to European gas prices was even crazier. We're talking a spike of an incredible 98%. It was a vicious 1-2 punch that sent shockwaves rippling across the entire globe. And what's really wild is how fast this kind of poison spreads through the economic system. Right away, boom, it blows up headline inflation at the gas pump. But then it starts to seep into everything else. The cost to ship goods, the cost to make plastics, even the cost to grow our food. Forecasters, well, they basically had to tear up their predictions and start over. I mean, the OECD took its 2026 inflation forecast for the US and jacked it all the way up to 4.2%. But here's the plot twist nobody saw coming. While that external shock from the Middle East was the spark, the truth is the American economy had already been soaked in gasoline. We were just incredibly vulnerable, and it was because of a series of, well, self-inflicted wounds, economic own goals that made this whole crisis so much worse. That's right. While everyone's eyes were on the Middle East, a couple of economic time bombs set by our own domestic policies were already ticking away right here at home. Let's start with the first one, the tariff time bomb. See, back in 2025, when new tariffs were put in place, it didn't seem to hit us, the consumers, right away. U.S. importers basically just ate the cost because they didn't want to lose market share. But here's the catch. They were just burning through their old, cheaper stockpiles. By early 2026, poof, those are gone. And by the middle of this year, the bill finally came due. Those costs got passed directly to, you guessed it, you. Time bomb number 2, let's talk about the fiscal deficit. It's a simple concept, really. It's the gap when the government spends way more money than it brings in through taxes. You can think of it like the government using a giant credit card to pump cash into the economy. Now, sometimes that's helpful, but when the economy is already running hot, it's literally like pouring gasoline on a fire. And the U.S. isn't just running a little deficit. Oh no, it's running a monster. It's projected to be over 7% of the country's entire economic output. So at the exact moment we needed to be cooling things down, fiscal policy had its foot slammed on the accelerator. And this all leads us to the Fed's huge miscalculation. See, they believed their policy was restrictive, that they were really fighting inflation hard. This whole belief was based on a pretty tricky economic idea called R-star. It's this theoretical interest rate that's perfectly neutral. It's not slowing things down, but it's not speeding them up either. The Fed's models said this R-star was really low, but the 2026 reality with all that government spending, it suggests the true neutral rate is way, way higher. So what's the bottom line? The Fed thought it was slamming on the brakes, but in reality, its foot was barely even tapping them. But all this high-level talk about policy and theoretical rates, it misses something really important. Because for most of us, the economy isn't about spreadsheets. It's about the price of eggs at the grocery store.
This quote here from the Peterson Institute absolutely nails it. We as humans are just wired to remember the sting of paying more for things we buy all the time. Your brain doesn't really register a slow change in some big aggregate inflation number. It registers the shock when you see your grocery bill.
And this gets right to the psychology of it all. We notice the price of gas or eggs because we buy them every single week. They're what we call salient. They're frequent, they're high visibility. We just don't notice our mortgage or our car payment in the same way, even though they're a much bigger chunk of our budget. And this is exactly why the official inflation numbers can feel so completely disconnected from our day-to-day reality. So why is this so important? Because when you see the price of everyday stuff going up and up and up, your expectations can become what economists call de-anchored. It's like your brain's internal compass for what things should cost just breaks. You start to think that high inflation is just the new normal, and that changes how you act. You ask for bigger raises at work. Businesses start raising their prices because they expect their costs to go up. It creates this dangerous feedback loop, a self-fulfilling prophecy that makes the Fed's job next to impossible.
Which brings us to our cliffhanger ending, because we're not just watching one horror movie anymore. Oh no, we're now stuck in a terrifying double feature, the threat of stagflation, plus a brand new risk that's been hiding in plain sight. First, let's talk about the stag part of stagflation, stagnation. This energy shock isn't just pushing prices up, it's also killing economic growth. The OECD data here tells the whole story. Projections are getting slashed everywhere. World growth is slowing. And just look at the euro area. It's expected to grow by a measly 0.8% this year. That right there, high inflation plus low growth, is the classic recipe for economic misery. But remember, I said a double feature. There's a second threat. The one real bright spot in the economy, the engine that's been driving investment and the stock market, it's been AI. Artificial intelligence has been the hero of the story so far. But, as we know, every hero has a potential dark side. This warning from the IMF is actually kind of chilling when you think about it. So much of our recent economic optimism has been built on the promise of AI. But what happens if the hype just turns out to be hype? The result could be a total collapse in tech investment, which could trigger a major stock market correction. It would be an absolutely devastating financial shock, hitting us at the exact moment the real economy is already on its knees. And that's where we have to leave it. The first inflation crisis back in the day, it felt like a total surprise attack. But this sequel, with the delayed tariffs, the massive deficits, the Fed miscalculations, you really have to ask yourself, was this just an unlucky, unavoidable shock? Or was this a crisis that, in a lot of ways, we actually helped create ourselves?